Okay everyone, welcome back to Pete's Investing. In this strategy edition, we'll be talking about combining a fast and slow stochastic approach coupled with moving averages, and also applying a percentage gain and average down approach. But first, the legal stuff. We're not offering financial advice, but rather it's an educational series to help you make better trading decisions. So what we have here is applying a triple moving average. This black line is the moving average 200. This is on a daily chart. This dark blue line is the exponential moving average 50, and this is the exponential moving average 20. So, and down here we've got a slow stochastic and a fast stochastic. Now the slow stochastic, were applied stochastic 25, 9 and 5 parameter, and this fast stochastic we applied 14, 3, 3 in terms of their parameters. Okay, so the entry rules are, we want the exponential moving average 20, the pink line, to be greater than the exponential moving average 50, the blue line. Also to be greater than the moving average 200, the black line. That's our first set of parameters, must be met. Secondly, the K line of the stochastic fast, the red line, must be crossing over the black line, the D line, which it does there. That also has to be less than the value of 40. So once that parameter is met, we enter our first lot of shares there. In other words, you don't want to enter when the stochastic is up in this area of the 60 or 70 value area. We want to get it when it's below 40. Our exit criteria, it must gain at least 1% from the entry price to be in a profitable position at least. And when the slow stochastic, the K line, breaks below the black line, the D line, that's our exit parameter. That's where we enter the trade and exit the trade. Okay, let's look at the average down approach. So let's look at this area over here. We enter our first lot of shares, the same criteria as before. The pink, or the exponential moving average 20, is greater than the exponential moving average 50, which is greater than the moving average 200. Also, the fast stochastic is less than 40, and where the red, or the K line, breaks above the black line. So we enter our first lot of shares there. Now in this case, the price drops off. This is a period during COVID. It's March 2020. The price drops off, then starts to appreciate. Now you'll notice the exponential moving averages are below the 200, so we don't consider any more entries until this point up here. Price starts gaining ground. The prices move above the moving average 200. The exponential moving average 20 is above the exponential moving average 50, and also the stochastic, the fast stochastic, the red line, or K, breaks above the D line, and it's below 40. So that's our entry level, again being met. So we enter another lot of shares there. We'll keep going, and we must gain greater than our average price. So average price will be somewhere between that point and that point, so somewhere in the middle, somewhere around there. And when we're greater than the average price, we exit when the slow stochastic breaks down, the K line breaks down below the D line, which it does there. That's where we exit the trade. Here are the trading rules for the fast and slow stochastic with triple moving average, and I've applied this to a daily chart. So we enter when the first trade, or we enter in both average downing and a first trade when the exponential moving average 20 is greater than the previous EMA 20, and when the exponential moving average 20 is greater than the exponential moving average 50, and the exponential moving average 50 is greater than the moving average 200. We also look at the fast stochastic with the parameters of 14, 3, 3, when the K line is greater than the D line. When it crosses over, that's when we enter. And also when the K stochastic is less than the value of 40. That's our entry parameters. We exit the trade when the close is greater than the average price. We want to make sure we're profitable. And we exit when the slow stochastic, 25, 9, 5, the K line crosses under the D line. That's our exit strategy. The average down approach is similar to the entry, is when the EMAs are greater than the moving average 200, as above. When we decline by at least 1% of the value of the share price, and we buy 2 times the previous number of shares. Lastly, what I'll show you here is the where that strategy ranks in amongst the strategies we tested thus far. So what I'm doing here, for those newbies that haven't seen my videos, I pick a number of shares, and these shares, the share prices go sideways, go upward, or go down. So I'm just trying to pick a variation of the share price movements. So these 7 shares sort of help address those areas. So out of those shares, I then look at the profitability, and this table shows the profitability over the period going back to 2007. This table shows the same number of shares with the maximum drawdown reached of the above. And the drawdown, just so I hope you understand, is that highest profitability down to the lowest profitability throughout the whole period or the whole history being tested. So in this example, that point there to that point there would have been the maximum drawdown. These two are little drawdowns, but they weren't the maximum drawdown. So that's what I call the maximum drawdown. So again, looking at this table, this drawdown represents the maximum drawdown throughout that history of that particular trade or that share price. And this last table down here just simply shows the percentage profit over drawdown percentage. So basically the profit divided by the drawdown gives you a percentage. So where does our program today sit in the ranking? As you can see here, I've highlighted in yellow, this is the stochastic, the fast slow stochastic. So it generates about $14,500 worth of revenue. The maximum drawdown is about $19,500. So the profit over drawdown percentage is 111%. So that in amongst this table is pretty low. So not that effective in terms of some of the other strategies. I have backtested some of these other strategies and put out videos on some of these other ones. There's the alligator strategies, the 2 top there. So just go back and look at my playlist and try and find those there to review those. But that's where today's strategy shows up. Here are some of my investing rules. Buy proven blue chip stocks only, avoid speculative stocks. This ensures the probability of the shares of the company you're buying has had a good track record and more likely potential of future growth. Buy stocks which pay dividends. Do a quick search of the stock before buying to ensure it recently paid a dividend or is about to. This is a good indicator that the company has future potential of growth. If the company recently stopped paying dividends, it may be a sign that their growth potential may be challenged. Don't short positions, go long only. If you short up an instrument which pays a dividend, you'll end up paying that dividend to someone else who went long on the same instrument. Do not trade on news. Price is already factored in the share price. If you read an article in the finance pages which talks about an event on the stock you're considering, the chances are it has already been factored in the share price. So you've missed that boat. I did a video in September 2021 titled Uranium Stock Too Late to Trade, which demonstrates the effect that news has or hasn't in the share price action. Suggest you watch that video to get a better understanding. To be able to ask specific questions, feel free to log on and sign up to the Pete's Investing Patreon page. That's where I get more specific questions answered and help support the channel. Thank you.